Welcome back to Financial Market Insights for Traders, your go-to source for strategies, trends, and practical tips to help you trade smarter and protect your investments. I'm your host, Sophia, and today we're talking about something that's absolutely essential in unpredictable markets: hedging and derivative use. Now, I know what you might be thinking. Hedging, isn't that something only big institutions or hedge funds do? Well, no. Whether you're a retail trader protecting a single stock gain or an international investor safeguarding against currency swings, hedging is a tool you can use, and honestly, should use, if you want to keep your hard-earned profits from slipping away. In this episode, we're going deep. We're going to cover why hedging matters, practical ways of using options to protect stock gains, the most effective currency hedging strategies, how to combine them for multi-layered protection, and the real-world costs you need to weigh. I'm also going to share some specific tools and resources that make it so much easier to put these strategies into action. So, grab your coffee, settle in, and let's get started. Why hedging matters. Here's the thing about investing. Making gains is one challenge, keeping them is another. We all love the thrill of a winning trade, but without protection, a single piece of bad news can send your position underwater. Hedging is basically like wearing a seatbelt in your car. It doesn't stop the bumps or the unexpected traffic, but it can drastically reduce the damage if things take a sharp turn. And in markets, that sharp turn can come from anywhere: earnings surprises, sudden interest rate changes, a geopolitical headline. There are three big reasons hedging matters. Risk management: it reduces the impact of adverse moves without you having to exit your core positions. Capital preservation: it helps you lock in profits on winning trades. Investment continuity: you can stay invested through volatility rather than selling too early and missing potential upside. Imagine this: you've got a high-performing tech stock. You believe in the company's future, but earnings season is coming up and you know volatility will spike. Do you sell and trigger taxes? Or do you find a way to protect yourself while keeping your position? That's exactly where hedging comes in. Using options to protect stock gains. Let's start with options because they're one of the most versatile and accessible ways to hedge as a retail investor. Protective puts, your safety net. A protective put is probably the most straightforward hedging technique. With options, you already own the stock, and you buy a put option with a strike price close to its current value. That put gives you the right to sell at that strike price within a certain time frame. Let's run the numbers. You bought shares at $50. They're now trading at $80. You buy a 3-month put option with a $78 strike. If the stock tanks to $65, you can still sell at $78. You've locked in most of your gains without selling your shares outright. The beauty here is that if the stock continues higher, you still benefit from the upside. The trade-off? You pay a premium for the put. And if the stock never drops, that premium expires worthless, just like paying for insurance you don't use. Covered calls, income while you wait. Another option strategy for protecting gains is the covered call. This is more about generating extra income rather than pure downside protection. You own the stock, and you sell a call option at a price above the current market. Example: your stock is at $80. You sell a call option with an $85 strike for a $2 premium. If the stock stays under $85, you keep your shares and that $2 per share in premium income. If it rises above $85, you may have to sell at that price, but you still pocket the premium plus gains up to $85. It's a trade-off: capped upside for steady income. Great for flat or mildly bullish outlooks. Currency hedging strategies for global investors. Now, if you invest internationally, you're not just playing the stock market, you're also playing the currency market, whether you like it or not. Let's say you own European stocks. Even if the share prices go up, if the euro weakens against your home currency, your returns can be wiped out. Here are the main tools for currency hedging. Forward contracts. A forward contract is a private agreement to exchange one currency for another at a set rate on a future date. It's common for exporters, but investors use them too. They're flexible, but since they're not exchange traded, they carry counterparty risk. The downside is they lock you in. You can't benefit if the rate moves in your favor. Currency futures. Currency futures are similar, but traded on regulated exchanges. They're standardized, liquid, and transparent. Less customization than forwards, but easier to trade in and out of. Currency options. Currency options give you the right, but not the obligation, to exchange at a set rate. That flexibility lets you benefit from favorable moves while still having downside protection. Of course, that flexibility comes at a premium cost. Hedged ETFs. For passive investors, there are ETFs with built-in currency hedging. For example, a Japan equity ETF that automatically neutralizes yen exposure for US investors. It's hands-off, but you don't get to fine-tune the hedge yourself. Combining stock and currency hedges. Some portfolios have multiple risks at the same time. Imagine holding shares in a European company traded in euros. You've got two risks, the stock price itself and the currency exchange rate. In this case, you might buy protective puts on the stock. Use a forward contract or currency option to lock in the euro to dollar exchange rate. That way, you're defending the value of the stock and the value of the currency it's denominated in. Costs, pitfalls, and best practices. Hedging isn't free. You've got to weigh the benefits against the costs. Options premiums can eat into returns. Futures and forwards might tie up capital or margin. Overhedging can limit your upside more than it protects your downside. Best practices? Only hedge when the potential loss justifies the cost. Match the hedge size to your exposure, don't overshoot. Reassess your hedges regularly. Markets move fast, and a good hedge today might be irrelevant in a month. The role of execution tools. Even the best hedge can fail if your execution is slow or clunky. You need real-time data, clear analytics, and fast, reliable trade execution. That's why I recommend a world-class, cutting-edge, user-friendly trading platform app like crystalballmarkets.com trading platform. It's built for both new and experienced traders with intuitive order management, advanced charting, and secure execution all in one place. Building your knowledge. And remember, tools are only as good as the person using them. The more you understand markets, the better your hedging decisions will be. That's why I love the Crystal Ball Markets podcast. It's beginner-friendly but packed with insights on trading, investing, macroeconomics, and financial markets. If you want to deepen your understanding and get real-world context for your trades, it's an excellent listen. Real-world example, tech stock and AMP, yen exposure. Let's wrap with a real-life scenario. You own $100,000 in a fast-growing US semiconductor stock, up 45% over the past year. You also have $50,000 in Japanese equities. Risks. Tech stock could drop after earnings. Yen could weaken against the dollar. Hedging plan. Buy 2-month protective puts $5 out of the money on the tech stock. Enter a US dollar to Japanese yen forward contract to lock in today's exchange rate for your Japanese holdings. Result. Even if earnings disappoint and the yen falls, your downside is contained. You've insulated yourself from two very different risks without selling a single share. So, here's the takeaway. Hedging and derivatives aren't about predicting the market, they're about preparing for the unknown. By using options to protect stock gains and applying smart currency hedging strategies, you can control your risk and safeguard your gains, even in unpredictable conditions. If you're serious about taking your trading to the next level, I recommend getting started with Crystal Ball Markets platform. It's a powerful, easy-to-use hub for derivatives, forex, and equity trades. And, of course, make sure you subscribe to the Crystal Ball Markets podcast for more trading strategies, market insights, and practical tips. Remember, protecting your gains isn't about luck, it's about planning. And the best time to plan is before you need it.